Over the last few days, ever since the new year is born in January 2022, we have seen the Bombay Stock Exchange Index, Sensex, move down from a level of 62,000 points, almost down to 57,000 points as I do this video. Almost a drop of 5,000 points. Now 5,000 seems a big number, but let's kind of put it in perspective and understand what this drop means. Right? In the normal context, any stock market related investments in the long term is expected to deliver a return of anything about 10 to 12% per annum. Now this is not linear, but over an average of 5 years, the expectation is that investors will make about 10 to 12%. Given this fact, if the market drops at any given point in time, and with that drop over a period of say 5 or 10 trading sessions, takes down the value by about 3 years of earnings or 2 years or 2.5 years of earnings. To give you a simple example, if 10% is the annual earning, and if the market drops by say 25% over a 5 or a 10 sessions, then we can safely conclude that that represents a crash. Right? And a crash is always preceded by an event that triggers the crash. There is always a panic reaction due to which investors end up selling in a hurry. Examples of some big crashes that have happened in the last 2 decades could be the Twin Tower blasts in the US, post which we had a similar kind of a drop. Again, about 10 years ago, the Lehman crisis in 2008-9 had investors in panic mode. Therefore, again, we saw the stock market do a big downward tumble. And as recent as 2 years ago, when the COVID pandemic was first detected and announced, due to the lockdown and its impact, the markets again dropped in the month of March. So in all these cases, Sensex as a value dropped more than 30% at various intervals. And that, my friend, is what we call a crash. Now, is crash terrible? Yes, absolutely. While the immediate impact is that your portfolio is down significantly, but in all these 3 instances that we saw, eventually the markets recovered as well. So while the initial part of the crash has its hurt on investors' money, but as long as investors stay invested in the portfolio, and these are good portfolios, they tend to recover in a matter of months. In some cases, the recovery has been as short as 6 months' time, in some cases about a year and a half. But in most cases, the recovery has been recently rapid. So that's about a crash. Let's understand what a correction is, because these are the terminologies that are thrown to us by every newspaper, right? Now, a correction is nothing but a drop in the stock market, or the Sensex as we may call it, which usually represents about 1 to 1.5 years of earnings. So in the current example which we spoke about, if 10-12% represents a year's earning, about 10 to 15% drop in the market value can be considered as a correction. Now friends, unlike a crash, a correction is actually welcomed by most people. Most seasoned investors don't consider correction bad. In fact, they consider correction a very healthy thing to happen in the market. The reason being is that a correction makes sure that the anomalies that are there in the market in terms of overvaluation or in terms of some of those stocks which are unfairly priced high or low, all those things get corrected in a correction. So most investors, especially those with experience, welcome corrections, and that's what we would like to leave you behind, as corrections are a very healthy trend. Christopher Davis, the director of Coca-Cola and also an independent financial professional in New York, had the following thing to say. He said, a 10% decline in stock market at least once a year is a given thing. And people who realize this and understand this and do not react to it are the people who make a lot of money in the stock market. So true, my friends. Now let's understand, if your portfolio is down, be it a crash or correction, what must you be doing? Now, there's a 4-step process that one needs to follow. First up, always when your portfolio is down, review the entire portfolio. Look at every component of that portfolio with a critical eye, every investment, to see if that investment holds the promise that it did before the fall and continues to do, right? Second, understand if that fall is temporary or permanent in nature. If it is temporary in nature and you don't have a need for the money, then might as well stay invested in that portfolio, right? It's a good idea because the markets may bounce back and reward you. Third, if the portfolio is good and the fall is there, it's a great opportunity to add to your portfolio, right? So look for additional surplus funds that you may have lying around and see if you can deploy it at a better valuation because the markets are down. Last but not the least, if there is some permanent damage because of the portfolio being down, a stock that you bought has gone down and irretrievably is kind of at a point, it's best to sell it, exit, and redeploy your funds. Use this as a great opportunity to clean up your portfolio and get your portfolio in the pink of health. Friends, if you do these 4 steps, every time the market is down, believe me, the next time the market moves up, your portfolio will be up and shining bright and red. I hope this message was useful.